Hi, so we are going to see basics, residential status and scope of income in your direct tax chapter. That is, this is lesson number 1 and 2 from your direct tax material. Okay. Okay. So moving on with the basic concepts. So what are the basics first? First is income tax is the most significant direct tax. Okay, income tax is the same as the direct tax. Both are the same. What is income tax? Income tax is nothing but a taxation which is levied on the income of an individual. Here, not only an individual, but individual, Hindu undivided family, association of person, body of individuals, firms, LLPs, everything will come under this purview. Okay. So, next, our union list entry number 82 of the union list, that is list 1 in the 7th schedule to article 246 of the Constitution of India. I am repeating it again. Entry number 82 in the union list. Okay, what is union list? It is the first list in the 7th schedule. Okay, so entry number 82, that is the entry number. Under which article? It is article 246 of the Constitution of India. Has given power to the parliament, okay, to make laws on taxes on income other than agricultural income. So, except this agricultural income, all other income are taxable. Who has this power to make laws? It is the parliament. So, the ultimate power rests with the parliament. Parliament has the ultimate power. Which has given the parliament the powers? Article 246 of the Constitution of India has given power to the parliament, and entry number 82 also provides or gives powers to the parliament to make laws. What laws? To impose taxes on the income other than agricultural income. Okay, agricultural income is exempt in India. Why it is exempt in India? Because agriculture, 60% of Indian income is based on our agricultural income. So agriculture is very important in India. That is why they have exempted agricultural income. But even in agricultural income, some portion is taxable portion. So we will see that in the next chapter. Okay, so moving on with this chart, that is what you see is significant components of income tax. What are the basic components of income tax? First is the Income Tax Act. Okay, you have the Income Tax Act 1961. So that is the most important act which gives you all the sections, which tells you what has to be done, how the tax is levied, everything. All the procedural aspects and law aspects are provided in the act. Next comes the Income Tax Rules 1962. What is the meaning of rules? That is, rules are actually being framed for proper administration of the act. Okay, first is there is an act, that is the Income Tax Act 1961. Now we have to ensure that this Income Tax Act 1961 is being properly formulated, or it has been properly implemented within the country. For that, we have Income Tax Rules 1962. So we have to follow these rules. Third, circulars, and fourth, notifications. So these circulars and notifications are issued by the CBDT. What is CBDT? It is Central Board of Direct Tax. CBDT is Central Board of Direct Tax. Okay, circulars are issued by the CBDT to clarify the meaning of certain provisions in the act. Okay, some provisions or some provisions or meaning in the act we might not understand the meaning. For that, circulars will be issued by the CBDT. Okay, just for a clarity sake. Notifications are given, which is, that is, these notifications are very important because they contains or they amend the rules. That is, the rules being modified. If the rules are being amended, how will we know that the rules are being amended? Only through notifications we come to know that the rules are being amended, modifications are being made. Okay, so these are the significant components, that is the basic of your income tax law. Section 2.8. Section 2.8 talks about assessment. Okay, what is the meaning of assessment? It is the process of examining the return of income by the income tax department. Okay, the process of examining the income tax return. What is return of income? See, suppose I am an individual, I will file my return of income. That is, income means what is my salary income, how many houses do I have, what is the income from this houses, what if I have any business, what is the income from my business, which is nothing but your PGBP. Okay, and income from other sources, if I had got any gift from my mother or father or from my sister, how it will be taxable. So all this income which I have received for a particular year, for 1 year period, that will be filed in a format given by the government, which is called as the return of income. Okay, so this return of income will have to be filed by each and every individual. Even if you do not have any income for a particular year, you have to file a nil return of income. Okay, so the examining this return, so after we file, after all the individuals file their return of income, this return of income will be examined by the income tax department. So that process is called as assessment. Okay, they will verify and they will check if whether we have made any mistakes. If we have made any mistakes, then they will issue a notice. Okay, notice, and we will have to pay penalty or interest for that. That's all. Okay, next is section 231, defines a person. Who is a person? Individual, Hindu undivided family, association of person, body of individual, partnership firm, cooperative society, company. These are all called as person. Okay, when we talk about individual, both men and women and minor person or a person of unsound mind are included in the individual category of individual. Who? Men, women, minors, or a person of unsound mind, all are included in the category of individual. Okay, next we have to see revenue receipts and capital receipts. Okay, both are different. So first, why should we know the difference between revenue and capital receipts? My first question, why should we know that? The answer is, the act contemplates the levy of tax on income and not on capital. This is your answer to the question. The act contemplates levy of tax on income and not on capital. Only on income we have to pay tax and not on capital. Hence, it is essential to distinguish between capital and revenue receipts. Okay, so capital receipts cannot be taxed, okay, unless they fall within the scope of the definition of income. So what they have done is, they have given a definition for income. Only if the capital receipts falls within the definition of income, such capital receipts will be taxable. Okay, tax is levied only on income, not on capital. Please remember this, very very important. That is why we have to know the difference between what is a capital receipt and what is a revenue receipt. Only for the revenue receipt, tax is levied. For capital receipt, tax is not levied. Okay, so let us see what a capital receipt is. Capital receipts are business receipts which are not related to day-to-day business activities. Okay, capital receipts are not related to day-to-day business activities. They occur occasionally. What is the meaning of occasionally? Only sometimes. Only sometimes they occur. Okay, capital receipts are normally presented in the balance sheet of the company. Where will you find the capital receipts? It will be found only in the balance sheet of the company. Okay, and what are the examples of capital receipts? Sale of fixed asset. Okay, issuance of capital in the form of shares. That is, if the company issues shares, that is called as capital. Only to increase the capital of the company, we issue or increase the shares. Issuance of debt instruments. Debt is also a kind where we can increase our capital. So all these three are your capital receipts. Okay, suppose in annual general meeting of certain company, the issue of rights issue was approved at the rate of 8 per share. Okay, this is an example. Okay, so suppose in annual general meeting of a company, the issue of rights share was approved at the rate of 8 per share. Okay, that company allocates the shares to all the existing members of the company. So what the company receives cash. Okay, and this is called as a cash receipt, sorry, capital receipt. Why? Because the company is issuing a rights issue or rights shares to the members of the company. The members give money to the company. So this money will be called as capital receipt or a capital money. Hence, the tax will not be levied on such capital receipts. Okay, do you understand? So what a capital receipt is, they are business receipts which are not related to day-to-day activities. So they are not related to day-to-day activities, they occur sometimes only, they occur occasionally. Okay, and sale of fixed asset, issuance of capital, that is issue of shares, issue of debentures, they are all are your capital receipts. Okay, I gave you an example also. So suppose one company is issuing rights shares to the members of the company. The members in turn pay money to the company. That money will be called as your capital money or your capital receipt. Hence, this is a big example of capital receipt. We have some other examples for capital receipts also. They are cash received from sale of fixed asset, amount of loan received by the company from a bank, that is also a capital receipt, capital invested in the business by a new partner, that is a capital business, consideration received by a company through sale of its license. Okay, if they sell any license, the consideration received is a capital receipt. Now next, revenue receipts. Revenue receipts is just the opposite of capital receipts. Okay, that is they occur routinely, they occur in all day-to-day activities. Okay, so here also I have given you an example, that is suppose a company is in the business of manufacturing and selling baby diapers. Okay, they are manufacturing and selling baby diapers. Now the company invoices its customers. Okay, these baby diapers are being sold to the customers and they are receiving the money. This is called as a revenue receipt. This is a revenue to the company. This is not a capital. This occur on a day-to-day activity because daily they sell diapers. Daily the customer buy diapers. So it is a day-to-day activity. Okay, hence this money which the company is receiving is called as a revenue receipt, and only this money will be chargeable to tax, that is tax will be levied only on this money, revenue receipts. Okay, what are the other examples of revenue receipts? It is revenue received from sale of goods to customers. Okay, revenue received from provision of services to clients, not only goods but even if they provide any services and they are incurring, they are receiving money, revenue, that is also called as revenue receipts because that is also an income. Income received as interest on savings account. We have a savings account in the bank, everyone will have a savings account, right? Month on month we will be getting interest on that savings account, so that amount is also called as a revenue amount, revenue receipt. Okay, that interest portion of 100 or whatever it is your revenue receipt. Rental income. Okay, we have a house, we give it for rent to some other person, we are receiving rent on monthly basis, so that rental income is a revenue receipt. Okay, cash discounts received from vendors. Okay, we are buying material from our supplier. Okay, and we are receiving cash discounts, this cash discount is also a revenue receipt. Okay, commission income received by a company, even commission received is a revenue receipt. Okay, so it is important for you to understand the difference between capital and revenue receipt. I have also given you the difference between the both. Okay, so capital and revenue receipt, what are the differences? Capital receipt is non-recurring in nature. That is, it occurs only occasionally. That is, only sometimes it occurs. What is the meaning of non-recurring? Non-recurring is they do not happen on a daily basis. But a revenue receipt recurs, it is recurring in nature. That is, it will take place on a day-to-day activity, as a day-to-day business activity. Okay, capital receipt occurs, that is, effect is carried to the balance sheet. In the balance sheet you will know what are the capital receipts. But what about revenue receipts? It will be shown in the income statement of the company. Revenue receipts will be found in income statement of the company, and capital receipts will be found in the balance sheet of the company. Okay, and examples for capital receipts and examples for revenue receipts I have told you before. These are the main differences between capital and revenue receipts. Okay, even if in the question, if they ask you, if they give you a question and if they ask you find whether it is a capital receipt or a revenue receipt, you have to run all these points. First you have to ask yourself a question whether this transaction is recurring in nature or non-recurring in nature. If it is recurring, what is the meaning of recurring? That is, it is happening on a day-to-day basis. Or non-recurring is it is not happening on a day-to-day activity. So if it is happening day-to-day activity, it is a revenue receipt. Okay, if it is not if it is a non-recurring in nature, then it is a capital receipt. This is how you have to differentiate between both. Okay, you need not mug up, just understand the concept. Okay, so difference between capital and revenue receipts we have seen. Now section 3, what is the previous year? Section 3 defines a previous year. Okay, so previous year means a financial year immediately preceding the assessment year. What is the assessment year? For example, 2018-19 is an assessment year. So what will be the previous year? It will be 2017-18. Okay, the next is, what is an assessment year? It is 12 months commencing from 1st April and ending on 31st March. That is called as your assessment year. Okay, now section 4, charge of income. All the income will be chargeable under section 4. Okay, so the act has specifically provided you with the rates of income tax, which is called as the slab rates. We have to apply those slab rates and we will find the tax on such income. Okay, slab rates we will see after few slides. Okay, we have certain exceptions to section 4. What are those? That is non-resident shipping business. If it is a non-resident having shipping business in India, then for him it is not taxable. He is not taxable in India. Why? Because he is a non-resident. Okay, and persons leaving India, persons who are leaving India, for them also no tax is levied. Association of person or body of individual formed for a particular purpose, that is, if they are formed for completion of a particular event, then for them that income will not be taxable. Then fourth is persons transferring property to evade tax. Just because to evade tax, what is evade? Evasion means to avoid tax. Okay, just for avoidance of taxation, the persons transfer their assets to some other people. So for them also tax cannot be levied because it has been transferred. Discontinued business. Okay, if a business has been discontinued, you cannot levy tax. Okay, next is the rate of income tax. These are the slab rates. Okay, I have given it to you in my notes also. You have to read all these slab rates, you have to mug them up. There is no other option. Okay, because these are all limits. Direct tax, you have no other option, you have to mug up all those provisions. Okay, so first is individual. That is individual other than a resident individual of age 60 years or more, that is for individual lesser than 60 years or more. For them, if the total income is less than or equal to 2,50,000, income tax payable is nil. So if the total income is more than 2,50,000 but less than or equal to 5 lakh, the income tax payable is 5% of the amount by which the total income exceeds rupees 2,50,000. Okay. Third, if the income is greater than 5 lakh but lesser than or equal to 10 lakhs, then the tax will be 12,500 plus 20% of the amount by which the total income exceeds 5 lakh. You just have to follow this slab rate. Okay, nothing else to explain here. If the total income is greater than 10 lakhs, the tax is 1,12,500 plus 30% of the amount by which the total income exceeds 10 lakhs. This is the first category. Now we are going to see residential income of age 50 years or more but less than 80 years. Okay, that is for age more than 60 years, sorry, age of more than 60 years but less than 80 years. If the total income is lesser than or equal to 3 lakhs, the income tax payable is nil. Okay, if the income is more than 3 lakh but lesser than or equal to 5 lakh, then the income tax payable is 5% of the amount by which the total income exceeds 3 lakh. Now if the total income is greater than 5 lakh but lesser than or equal to 10 lakh, then income tax payable will be 10,000 plus 20% of the amount by which the total income exceeds 5 lakh. Last category, if the total income is greater than 10 lakhs, then the income tax payable is 1,10,000 plus 30% of the amount by which the total income exceeds 10 lakhs. Okay, this is your second group. Now third, for residential individual whose age is above 80 years. Okay, above 80 years, this is also called as super senior citizen. Okay, super senior citizen, that is more than 80 years. So for them, if the total income is less than or equal to 5 lakh, the income tax payable is nil. Total income is greater than 5 lakh but lesser than or equal to 10 lakhs, the income tax payable is 20% of the amount by which the total income exceeds 5 lakh. And if the total income increases 10 lakhs, then income tax payable will be 1 lakh plus 30% of the amount by which the total income exceeds rupees 10 lakh. Okay, this is the slab rate. Now next we have applicability of surcharge and rebate. Okay, for whom surcharge and rebate is applicable. First, when the total income is less than or equal to 3,50,000, then surcharge is not applicable. Rebate is applicable, that is income tax on total income or 2,500, whichever is less. That will be your rebate amount. Okay, only when the total income is less than or equal to 3,50,000, you will have rebate. If the total income is above 3,50,000 but lesser than or equal to 50 lakhs, then surcharge also is not applicable and rebate is also not applicable. If the total income is greater than 50 lakh but less than or equal to 100 lakhs, then the surcharge will be 10% of income tax. No rebate is applicable. If the total income is more than 100 lakhs, then the surcharge will be 15% on income tax and the rebate is not applicable. Okay. Okay. Now, rates of income tax for firm or LLP. LLP is limited liability partnership and companies. Okay. So for these two categories, what are the rates? We saw the rates for individuals. Individuals below 60 years, individuals from 60 to 80 years and individuals above 80 years. Now we are going to see the rate of income tax for companies and firms, partnership firms or LLP firms. Okay. So first is, we are going to see for a firm or a LLP. The rate of income tax is 30%. Okay, very simple. Now, for a company, under company we have domestic company and foreign company. Okay, what is a domestic company? Company which is registered in India is called as domestic company. Foreign company, company which is registered outside India is called a foreign company. Now, domestic company, we have two categories under domestic company. First one is where the total turnover or gross receipts in the previous year 2008 17-18 is less than or equal to 50 crore rupees. This is our first category. That is, if the turnover is lesser than or equal to 50 crore in the previous year. Okay, so the rate will be 25 percentage. Okay, in any other case the rate of income tax will be 30 percentage. Okay, for foreign company, here also we have two categories. The first category is royalties and fees for technical services are received from the government. Okay, that is royalties and fees received from the government. In that case the rate of tax will be 50 percentage. Other income other than royalties and technical fees, the other income, it will be for 40 percentage. This is the rate of income tax for companies and firms. Rate of surcharge. Okay, first we have four category, that is for individual, Hindu undivided family, association of persons, that is our first category. Second we have firms or LLPs. Third, domestic company, and fourth is foreign company. Okay, so first we are going to see for individual or Hindu undivided family. So if the total income is lesser than or equal to 50 lakhs, then surcharge is nil. If the total income is greater than 50 lakh but lesser than or equal to 1 crore, surcharge is 10 percentage. If the total income is greater than 1 crore, then the surcharge is 15 percentage. Now for firm or LLP, if the total income is lesser than or equal to 1 crore, the surcharge is nil. If the total income is greater than 1 crore, the surcharge is 12 percentage. Next, for domestic company, if the total income is less than or equal to 1 crore, surcharge is nil. If the total income is greater than 1 crore but less than or equal to 10 crore, the surcharge is 7 percentage. If the total income is greater than 10 crore, then the surcharge is 12 percentage. Next, for foreign company, if the total income is less than or equal to 1 crore, the surcharge is nil. If the total income is greater than 1 crore but less than or equal to 10 crore, then the surcharge is 2 percentage. If the total income is greater than 10 crore, then the surcharge is 5 percentage. Okay, note, what you have to note here, income tax has to be computed on total income only. First point, income tax has to be computed on total income only. Surcharge is computed on such income tax. Second point, surcharge is computed on such income tax. Education cess at 2 percentage and secondary and higher education cess at 1 percentage is on income tax plus surcharge if applicable. Okay, first is you will calculate income tax on your total income. Then you will calculate surcharge on this income tax amount. Okay, then you will add income tax amount and your surcharge, add both, and in that added figure you will calculate the educational cess at 3 percentage. Okay, what are they? Where an individual Indian citizen leaves India in any previous year for the purpose of his employment. Okay, if any person leaves outside India for the purpose of employment, then this second basic condition is not applicable to him. Next category is if an Indian citizen being outside India comes to visit India during the previous year. Okay, he is born in India but he has settled in America and he comes back to India just for a visit, not to stay permanently in India. Okay, so for this person also second basic condition is not applicable. Next we are moving to additional conditions. First additional condition, he is a resident in at least 2 out of 10 previous year preceding the relevant previous year. Second additional condition, his stay in India in the last 7 years preceding the relevant previous year is 730 days or more. Okay. Okay. Now we are having three categories, that is resident and ordinary resident, resident but not ordinarily resident RNOR, and the third category is a non-resident. Okay, how will people come under these three categories is, first for ROR, what is ROR? Resident and ordinarily resident. Okay, that is must satisfy at least one of the basic condition. There are two basic conditions, either one or two they must satisfy. Okay, and both the additional conditions, there are again two additional conditions, so both of these two additional conditions must be satisfied. So if both of the additional conditions are satisfied and if any one of the basic condition is satisfied, then that person will be called as resident and ordinarily resident. Second category, resident but not ordinarily resident. Okay, if he satisfy any one of the basic condition and if he satisfies any one of the additional condition. Okay, if he satisfies any one of the basic condition and if he satisfies any one of the additional condition, then such person is called as resident but not ordinarily resident. Now last category, that is the non-resident. That is, if both the basic conditions are not getting satisfied, if both the basic conditions are not getting satisfied, then he will be called as a non-resident. Okay. Now what are the points which you have to remember? Residential status is determined for every day separately. Okay. India includes territorial waters of India. Okay, what is territorial waters? It extends to 200 nautical miles from India to the sea level, 200 nautical miles from the border of India to the sea level. Okay, employment includes self-employment also. In computing the period of 182 days, the day of entry into India and the day of exit from India shall be included. The day which he comes into India and the day which he goes out of India will also be included. Now, the person of Indian origin is a person who himself or any of his parents was born in the undivided India. Okay, that is before 15th August 1947. Okay, that is his parents or any of his grandparents also. Okay. After determining the residential status of individual or Hindu undivided family, these persons are further checked whether they are ordinarily resident or not ordinarily resident. Okay. Okay, these are conditions for individual. Next is for Hindu undivided family. Section 6, subsection 2. Okay, what are the conditions to be fulfilled? That is, if the control and management is in wholly or partly in India, okay, if the control and management is wholly or partly in India, then he will be called as a resident. If the control and management is wholly outside India, then he will be called as a non-resident. Okay, if the karta satisfies both additional conditions, that is 1 and 2 he has satisfied, then the Hindu undivided family will be called as a resident and ordinary resident or resident but not ordinarily resident. Okay, only if both the additional conditions are satisfied, he will be called as a ROR or RNOR. Okay. If both the additional conditions are not satisfied, then he will be called as an RNOR. Okay, read the provisions carefully here. Now, residential status of a firm, association of person and body of individual. Okay, if here also the same thing, if the control and management is wholly or partly in India, then it is a resident firm, is a resident firm. If the control and management is wholly outside India, then the firm is a non-resident firm. Okay, then residential status of a company. So here, first what we have to see is the company an Indian company? If the answer is yes, then if we have, then the next question is the company is a resident in India for the relevant previous year. Okay, this is the next question which comes to our mind. Now, if the company is not an Indian company, what will happen? The next is we have to see whether poem of the company is in India in the relevant previous year. What is poem? Poem. Poem is place of effective management. Okay, we have to see where the place of management is. If the place of management is in India, then the company is a resident company. If the place of management is outside India, then the company is called a non-resident company. Okay, very simple. Okay. Now next is scope of income. Section 5, scope of income. Under the scope of income, what we have to see is whether the income are to be included in the total income or not. This is what we have to see. So we are having particulars, next we are having ROR column, then RNOR column and the non-resident column. Okay, first, if the income is received in India, okay, if the income is received in India, then it is taxable for ROR, RNOR and for a non-resident. If the income is deemed to be received in India, what is the meaning of deemed here? You have not received the money now, but you will receive it in future. Okay, it is deemed to be received. You will get this amount, you will receive this amount in India in future. So in that case also it is taxable for all the three. That is, it is taxable for ROR, RNOR and for a non-resident. Third is income accrued in India. What is the meaning of accrued? Arise. Okay, income has arisen in India. It is taxable for ROR, RNOR and non-resident. Okay, if the income deemed to accrue in India, that is, in future that such income will arise in India. In that case also it is taxable for ROR, RNOR and for a non-resident. Now, income received outside India. What will happen to income received outside India? It will be taxable for ROR, taxable for RNOR and it will not be taxable for non-resident. Okay. Here a simple note. Income received outside India shall be taxable in the hands of RNOR only if business is controlled in India or the profession is set up in India. Okay, these two conditions we have to see. Only if the business is controlled in India, then it is taxable for RNOR. If it is not controlled in India, then it is not taxable for RNOR. Okay. Now, section 7. See, section 7, 8 and 9 will not be asked for your in your question, because section 7 is income received in India. What all we saw here? We saw here four thing: income received in India, income deemed to be received in India, income accrued in India and income deemed to be accrued in India. So these four I have given it to you in detail. That is, these are the sections in your Income Tax Act. But actually this will not be tested for your exam purpose. Okay, so what I recommend is just read the residential status conditions and your scope of income. I have also given you very detailed notes about this. Okay, this part can be ignored. Okay, because this is a waste of time. They will not be testing you in the exam. But still I have given it to you in notes. So after reading everything, you can read this also. Okay. Now, difference between tax evasion, tax avoidance and tax planning. Okay, what are the difference between the four? First, meaning. What is tax evasion? The illegal way of reducing tax liability is called as tax evasion. Whatever is done illegally, it is called as tax evasion. Okay, what is tax avoidance? The exercise by which the assessee legally takes advantage of the loopholes in the tax laws. Okay, the assessee takes advantage of the loopholes in the tax laws. That is called as tax avoidance. What is tax planning? Way of reducing your liability, tax liability. You read the entire act, you know what are the provisions, and you will find way to reduce your tax liability. That is called as tax planning. Okay, what are the characteristics? Characteristics for tax evasion is it is illegal. Okay, it is not moral. Okay, and for tax avoidance it is immoral. Okay, and for tax planning is only moral in nature. We all have to follow tax planning only. We should not avoid tax and we should not evade tax also. We must plan our taxes. Okay, aim aim for tax evasion is to reduce the tax liability by applying unfair means. Okay, for tax avoidance it is to minimize the tax liability by applying script of law only. That is, script here means the loopholes of law. Okay, tax planning to reduce, aim is to reduce tax liability by applying the law morally. Okay, practice, tax evasion is practiced. What is the practice here? Concealment of tax. What is concealment of tax? Concealment means you reduce your income and show it to the return of income. You would have got 5 lakhs as your income, but you will show 1 lakh only in your return, income tax return. So that is called as concealment of tax. You reduce your own tax income. Next is for tax avoidance, it is hedging of tax. Okay, what is hedging of tax? Hedging of tax is also reducing your tax. Okay, the same meaning. And for tax planning it is saving of tax. You will save tax. That is your practice. Approach, what will be the approach used? It is concerned with the past and applied after the liability of tax has arisen. Okay, for tax avoidance it is futuristic. Okay, for tax planning also it is futuristic and it is positive in nature. You will always have a positive approach when you do tax planning. Legal implication, tax evasion it overrules law. Okay, tax avoidance it uses the loopholes in the law. Third, tax planning it uses benefits of the law. Okay, advantages of tax evasion not leads to we don't have advantages for tax evasion. If we are caught, then we have to pay huge penalty. There are no advantages for tax evasion. Similarly, no advantages for tax avoidance also. If we are caught, we have to pay interest and penalty. For tax planning, there are lot and lots of advantages. First, you will not get caught because you are planning your tax and you are filing your income tax return regularly and you are paying correct taxes to the government. So there are more advantages, okay, in long run. Okay, so these are the basic differences between tax evasion, tax avoidance and tax planning. So these are your basic concepts. What is important here is the difference between capital and revenue receipts, okay, and the difference between tax evasion, tax avoidance and tax planning. And third is your residential status and scope of income. Okay, please read them and revise them on a regular basis. Okay, thank you.